Hi, this is a quick video on core and satellite investing, which is predominantly what I do. Our investment approach is generally a little bit more in the risky end of things, so that's why some of the returns we get are quite good. So just to run through core and satellite investing, the term's bandied around a lot, not a lot of people are all that sure of what it is. So to explain the theory, basically you have a core investment portfolio, which is the vast bulk of your portfolio. So it's represented here by what we've drawn in this blue circle just here as the core. So that's the vast bulk of the portfolio, and what it's comprised of is either a low cost strategy, something that doesn't cost you a lot of money and is very secure, or it's very low risk, and that's the bulk of your retirement savings. So if that's what you're talking about, your portfolio being comprised of. So you have a core of very secure, very safe assets, but to try and beef the return up without losing everything, you make a few smaller investments, like we've got here, these small blue circles that are drawn around it, and they're the satellites, the things that orbit around your core. And the idea is that by having a few of these satellites, generally they cost a little bit more money to invest, but they have the potential to earn a lot more money. So if we spend a bit more time now talking about what core investments are, many different approaches to what your core should be, and I'm sure your financial advisor will have their own views on what it will be, or if you're doing it yourself, looking after your own superannuation portfolio, you have your own ideas there, what they should be. There's a new trend towards using exchange traded funds, ETFs, as the core, very low cost, and they aim to just generate the same type of return that the market will generate at a very low cost. So you're not paying actively for someone to manage your portfolio and probably only get you a market return. You're getting a market return without paying a lot of money for it. Can be comprised of a blue chip share portfolio, or it could be cash. A lot of people have got nearly half their funds in cash at the moment, or some type of enhanced type cash product. However, partly why we're talking about core and satellite now is with the average super fund having about 40 to 50% cash in it, self-managed super fund, a lot of that cash is going to be having to find a new home as the government's been reducing interest rates. So people should be looking more towards this core and satellite and investing in a few riskier assets that are going to generate them a higher return than what they're getting off their cash. And that core is probably a little bit too large in some of those portfolios. So just to summarize that core, these are low risk property type investments, infrastructure, or other very safe type investments. Now if you have a look at what the satellite investments can be, these are riskier assets. So the idea is you have a few of these satellites. If you can conceptualize it, moving around the core of your portfolio, they're either funds, share investments, or other higher risk investments that should be able to generate you higher returns than those safe investments. However, risk doesn't come without higher returns doesn't come without extra risk, and I guess what you need to really look at, and we've got it sort of mentioned over here, is risk adjusted. That's quite an important term for us. You need to work out the fund that returned a fantastic return last year. Generally, the next year they're not going to have a good return, and that's why people are always using that moniker that past returns aren't always a guide to future investment performance. So it is a standard disclaimer, but there's some truth in that. So what you really need to be looking at is maybe not the guy who's achieved the best return over the last year, but possibly the people that have had the least volatile returns. So rather than having someone that returns, for example, in what we do, a small company fund that returned 40% in the last year, you might be better with a guy who's returned 20% last year and 20% this year, because the guy who did 40% might be down 40% again next year. So that's the risk adjusted concept. Some of the examples of these core and satellite or the satellite investments are smaller company funds, hedge funds, and geared investments, all significantly riskier, and all should be small parts of your portfolio so that you don't end up in a situation as what happened with many of the Storm Financial clients. That was a geared investment portfolio. This last one here that we've mentioned, gear investment portfolio, they magnify your returns when the market's going up, but they also magnify your losses when the market's going down. So you really want to stay away from those type of things, or keep them very small satellites in your investment portfolio. And that's a good introduction to core and satellite investing.